Hey everyone, this is new. Probably going to be a little awkward on this first video, but hopefully I get some rhythm over time. I'm trying to find a good way to disseminate clear, concise messages about overall markets, market conditions, things that get my attention, certain aspects of, be it economic or maybe market-driven information that you're maybe seeing or hearing, reading about, someone's talking to you about it. I'm going to try my best to stay pretty current with these items, address new items that pop up as they do, but also give you a good understanding, hopefully, of why your portfolio is positioned how it is, what I'm looking at, what really I'm focusing on versus what you're being told to focus on if you watch any of your, pick your flavor news channels. So hopefully this is successful. If you like it, awesome. If you don't like it, I would love to hear what you didn't like, but also if there's a way that I could improve on this. Hopefully this will be fun though. So without further ado, I'm going to hop right into a couple broad topics with regards to our current markets and economy, and let's make sure we have very clear right away. Markets and economies are two different things. Let's not put those two in the same basket and say they're the same. Economies can be doing one thing while markets do another, vice versa. The important thing to know between these two, they do depend on one another. They do have a relationship, but generally speaking, markets act on whether or not economies or market conditions are getting better or worse. They don't necessarily act independently or absolutely, meaning just because you have a really good economy doesn't mean you're going to have a really good market. Likewise, a really bad economy doesn't mean a really bad market. The question is whether markets are getting better or worse, whether economies are getting better or worse. So that puts us today. Where are we? Economically speaking, remarkably strong. Employment figures, very strong. While there is a rash of new information regarding housing numbers, housing demand, builders spending, overall compression in the tech space, monopolization of tech. A lot of reasons why you would say perhaps the economy isn't doing that well. But in fact, what those are, from my vantage point, is those are symptoms of that bigger subject that I was talking about a minute ago, which is, are things getting better or worse? And if you think about it from the standpoint of let's just say specifically economies, or economically speaking, if things are really, really good, it's a lot easier for them to get worse than it is for them to get better. Considering that, the idea that economies may be getting worse, it doesn't mean they're going to be bad. It's an important thing to differentiate. The chance that this current economy flounders in a short term, not likely at all. What is likely to occur is that the sentiment surrounding the economy may see some shifts towards a negative direction. The markets in general see themselves more timid. If we look back to 2016, we had an election year. Markets were all over the place. Volatility was very high. We had the Brexit decision that was starting at that point in time in June. We saw markets seesawing back and forth. But what is important to know is that markets don't like uncertainty. So now we've got two things, strike one, strike two, strike three. Strike one, economies, when they're very, very strong, it's a lot harder to get better. It's a lot easier to get worse, and markets care whether things are getting better or worse. So, high probability things will get worse if they aren't already. Strike two is uncertainty. Markets care about uncertainty. Markets don't care who's president. Markets don't care what policies go into play. The reason I say that is, I want to be very careful to clarify. There are some policies that can go into place that are very detrimental to markets. But if we look at markets as a zero-sum game, there are always going to be definitive winners and losers. One policy decision favors one subset of companies. One policy decision favors the other. The point is, though, the thing that doesn't favor the collective group of, be it stocks or bonds or whatever it may be, that you want to lump together, the one underlying threat to them all is uncertainty. The idea of we don't know who's going to be making decisions. We don't know what's going to come of a situation. While that always is the case, no one can see the future. When you start looking at political cycles, it's hard to believe that we're, already 3 years out from the 2016 election cycle, which means we're ramping back up for another election cycle. Previous presidents would typically go into an election with a high sense of confidence that they'd probably come out okay. They'd probably win the incumbent presidency. With Trump, I do think it is questionable. And it's not that I don't think he will win. What I do think gets my attention is that markets are not sure whether or not he could win re-election. Frankly, that's not my job to try to call it. I think it can happen, but I don't think markets in general think it can happen. So that means uncertainty. We'll probably see even more uncertainty as the Democratic Party starts to narrow in on their one of 1,000 potential candidates. And they'll probably get it down to, maybe 10 or 20. And eventually they'll get it down to one. But we are seeing a lot of uncertainty. And I think that that's exacerbated by the fact that the policy agenda being adopted by many of these individuals is far more extreme. They saw how that worked for the Republican Party. The more extreme the candidate's position, the less moderate or centrist that they tended to be. They tend to get that extremely devoted following. And that's actually scary for policy. I know that a lot of people would argue Trump's done a great thing for the country. And I would be one of those people that would argue he has done some very strong, very good things for the long-term development of our country. However, extremism in general is uncertain. That creates a natural uncertainty. So, strike one, strike two. What is strike three? Strike three right now for me is a sentiment basis. Strike three. It's one thing for markets to have their sentiment, but the consumer sentiment, the sentiment of the average Joe or Jane, is, I think, going to be up against a pretty big hurdle coming into the summer months this year. I think the last big injection of positivity, and this could be strong enough that it ends up swaying the sentiment needle in a very positive direction, and it could completely unhinge this potential strike three for markets. But I think it's going to be the tax filing season that we're currently in. You're getting a lot of interesting news. A lot of headlines are saying tax refunds are lower. That's a very disheartening headline to read, because a tax refund being lower, first off, just as a side note, is a very positive thing. That means you didn't give the government an interest-free loan. The only reason you get a refund, if you think about the word, it means you spent money and you got it back. You gave the government money and they gave it to you back. The reason it's a bad thing is tax refunds are typically discretionary, spent discretionarily. They're discretionary income for households. They'll receive a tax refund, rather than think of it as excess savings, they tend to spend it. So that is negative. But the fact that people are getting less in refunds, again, as an aside, that's actually a very good thing. That means we are getting a more streamlined, simpler, and more accurate tax filing process and tax legislation working for us, because the withholding measures are more accurate now with the tax bill that came at the end of 17. If your tax refund is less, that is a good thing. That means you had your money in your pocket for you to choose what you wanted to do with it, rather than wait for the government to give it back to you with zero interest. So now that we have rising interest rates, or at least rates above zero, that's an even better thing. Now, let's go back to that though for a minute and say, okay, the news headlines saying people are getting less in refunds. I'm going to argue that on a whole, that's a farce. I think that that is manipulated data. I currently feel that that was a news story by one tax filing resource who typically deals with individuals who are tax inept. They don't comprehend their taxes, nor do they have a very complex tax filing scenario. H&R Block produced the information that said that, generally speaking, tax refunds are down. It has nothing to do with whether or not these people are intelligent, good. They're great people that file with H&R Block. However, the complexities of most people's taxes, or at least most people who have significant excess income that could be used for spending, don't use H&R Block to file their taxes. Nor do households who typically don't worry a lot about taxes, low-income households. So the sample data that was used for the information that's creating a news headline that's just simply being passed forward, like most news headlines today. Nobody actually looks at the data. Nobody actually stops and says, whoa, whoa, whoa. That doesn't make sense. They simply say, oh, great headline. It catches readers' eyes. It's getting a lot of clicks. Whatever it may be, push that news story. Push that news story. Well, and that's how you get crowd thinking, and that's how you get a lot of other problems that we deal with in today's society. But they're saying tax refunds are less. If that's true, it's a good thing. I actually don't think it's going to be true. That's also a good thing. That means that I really do think that people are going to end up getting a larger tax refund. While that's a bad premise, the good aspect of it is it does typically lead, as I said, to discretionary spending, which could be an unforeseen stimuli to our spending-based or consumption-based economy. And it may end up kind of kicking our proverbial can down the road a little bit further. It's just not likely to be something that boosts our economy in such an unforeseen way that we're able to circumvent those other two strikes that I mentioned. So there's a high probability that within the next 6 to 24 months, our markets become very tepid in a best case scenario, or potentially negative. And that really wouldn't surprise me. All right, let's talk portfolios here. Where do we stand? We saw a prevailing trend shift at the end of 2018. I would have loved to have said I could read the future. I can't. I cannot see the future. What I can see is whether or not a trend is developing, and most importantly, whether or not that trend becomes strong enough to become the prevailing trend. It did, in fact, take until December to see that a negative prevailing trend started. Here we are today, and while a positive trend has emerged, it's not prevailing yet. Right now, I have 2820 as a resistance line for the S&P 500. And I'll insert quickly here a graphic to show you the overall trend of the S&P 500. And you're going to see why 2820 is a significant mark. You'll find that 2820 seems to be that kind of mark where the market will try to get up to it, and as soon as it does, it kind of bonks its head and it falls back down. We need to be able to break through this resistance line, and until we do, it makes the most sense to say let's keep our defense on the field, which is why you have a lot of cash in your portfolio. If we can get past 2820, 2888. That's what I would call my green light signal. 2888. It's 2820, 2888. That's why we're sitting on so much cash. On the fixed income side of the world, the Fed is way too turbulent right now. Rates are going up. Rates stop. If rates start to go back down, if the Fed decides they're going to cut rates, if they feel the market is so soft, or that inflation numbers are so soft, or that wage inflation is so soft, or whatever the Fed decides to do, we don't want to be sitting out there too exposed. Likewise, if rates go up, we don't want to be too long on the curve. So with fixed income, we know that rates are better than they were, so we're happy to take a little bit higher rate of return on risk-free or nearly risk-free investments. Things that don't go up or down, but they still give us a little bit of coupon, a little bit of yield. But I'm not going to go out there and chase anything that's too wild or rambunctious. But I am going to position in such a way where we're protected. So I'm optimistic through tax filing season. I am pretty cautious, if not pessimistic, from about April through November of 2020. Something can change. I'm willing to change my mind, but that's where I stand right now, and that's how we will proceed with the portfolio. If you have any questions, if you want to talk about these things, just let me know. I'd love to hear from you. I'd love to talk to you about these things. For those of you who we've finalized all of the transitions, thank you very much. For those of you who are still working through it, bear with me. I promise I'm working as hard as I can. And I'm also doing the best I can. But I want to get this stuff squared away. I want to get this stuff done for your sake. And thanks for dealing with me blabbing for a while here. All right. Look forward to talking to you all soon.